Welcome, G-Traders. On a Wednesday morning, financial news and economic statistics are alarming. There are growing fears that the authorities' restrictive measures could cause a recession. Almost every new report reinforces these sentiments, and the Asia-Pacific region is no exception. The Chinese economy has been showing signs of a recession, with a decline in manufacturing activity and the labor market. After 3 years of severe restrictive measures, China has been trying hard to revive its economy. Beijing has launched a stimulus package, increased lending, and expanded credit availability. However, growth has been sluggish in the light of the ongoing crisis in the real estate sector. In particular, the two largest property developers, Evergrande and Country Garden, were on the verge of default, unable to pay their debts on time. The risk of a stagnation in the economy arose from the developer crisis and other problems. These were the reasons why Moody's downgraded the outlook for Chinese government bonds to negative. In response, China's Ministry of Finance said it was disappointed by the downgrade. The statement also claimed that the country's economy will be highly resilient and has large potential. However, the markets have heard optimistic statements from officials many times before. As it turns out, they do not always work. For example, the Chinese yuan has fallen more than 3% against the US dollar this year. While the world's second economy was trying to avoid collapse, the US economy was demonstrating amazing resistance to the aggressive policy of the US Fed. At the same time, the US currency and the US government bonds also dominated the global market. However, the situation is gradually changing, and economic reports of the last few weeks bring mixed data. For example, the index of manufacturing activity published yesterday exceeded forecast and continued to indicate the stability of the services sector in the United States. Labor market statistics, on the other hand, were weaker than expected. The reports recorded a drop in the number of jobs below the critical figure of 9 million. The disappointing results raised fears that the previously resilient US labor market may collapse under the weight of aggressive regulatory policies. However, the US dollar seems to have shrugged off this negative news. At the beginning of the Wednesday, the greenback held some growth, although it traded on a consolidation within the boundaries of 103.80 and 104.00 points. The US dollar index, which measures the greenback against its 6 major counterparts, stabilized above the 103.90 level. During the Asian trading session, the greenback remained near its 2-week high. However, the main reason for the greenback's modest gains may have been technical. After all, fundamental indicators are generally working against the US currency. The US economy is showing increasing signs of a significant slowdown this quarter, and the prospect of the Fed easing policy is becoming more tangible. Expectations of a softer stance from the Federal Reserve coincided with the investors' increased hopes for hawkish changes in a Bank of Japan policy. Therefore, the yen has spent the beginning of December strengthening against the US dollar. On a Monday, the dollar-yen pair declined to a multi-month low below the support level of 146.40 yen amid the US currency sell-off. Since then, the pair has rallied slightly, but is still trading in a range of 146.90 and 147.40. In the Asian session, the yen managed to break through the key technical resistance level at 147 and remains in a bullish territory. Like the US dollar, the Japanese currency was affected by opposing trends today. Another comment from the country's central bank spokesman about potential support for soft monetary settings weakened the yen, and Japan's preliminary producer sentiment index jumped to 12 points in December 2023. In November, it was high at 6 points. As the chip shortage eased, the country's auto production rose. It could have grown even more if not for the deterioration of the Chinese economy and sluggish sales of Japanese cars in the Chinese market. And today the Australian dollar rose amid China's pessimistic economic outlook and the market risk of sentiment. The Aussie managed to jump above 0.6595 after the release of Australia's third quarter GDP data. Although the data was weak in quarterly terms, it exceeded forecast on a yearly basis. According to the report, the economy grew by 2.1% from 2%. On the data, the Aussie dollar pair was able to keep the growth in the range of 0.6549 and 0.6599. The New Zealand dollar's turnaround was helped by the US dollar's consolidation in anticipation of a new economic data and support from the Aussie. Over the past 2 days, the New Zealand dollar has seen a sharp correction from 2 months' highs. As a result, it fell from a high of 0.62 to 0.6130. However, the Kiwi rose steadily and was trading in the range of 0.6128 and 0.6178 early Wednesday. It failed to reach its previous high, but it still maintained its bullish momentum near 0.6160. That's all for now. Stay tuned for more updates with the InstaForex TV. We appreciate your feedback. Please leave your questions and comments below, and see you soon.